housing markets in Melbourne are now officially out of reach for average wage earners.
What you're about to hear is the part of Melbourne's housing story that rarely gets spoken about out loud. Right now, across the city, thousands of brand new apartments are finished, unlocked, and ready for someone to move in. Yet no one is buying them. These aren't half-built towers or delayed projects. They're completed homes sitting empty, and their existence is quietly pulling the entire apartment market downward. While public announcements focus on short-term incentives and surface-level fixes, the underlying numbers tell a much darker story. Melbourne's apartment sector isn't just slowing down, it's buckling under its own weight. Prices are sliding, development has stalled, and people who bought apartments in the last few years are discovering their biggest investment is now worth less than what they paid. To understand why this matters, we have to start with the scale of the unsold stock problem, because it's far bigger than most people realise. Independent property analysts estimate that roughly 8,000 newly completed apartments across Melbourne remain unsold. That represents close to 1/5 of all units finished over the past 4 years. In plain terms, almost 1 in every 5 apartments built since 2020 has failed to find a buyer. That isn't normal market friction, that's a structural failure. These empty apartments aren't scattered evenly across the city either. They're clustered in the same inner and middle ring suburbs that were once marketed as the future of high-density living. The central business district, South Bank, Docklands, Footscray and Box Hill dominate the list. These were supposed to be the success stories, locations where infrastructure spending, transport links and population growth were expected to support endless demand. Instead, many buildings are barely lived in. Developers are now sitting on stock they can't move. Buyers know there's too much supply, so they wait. Sellers cut prices and still struggle. The result is a frozen market where transactions grind to a halt. The pricing dilemma makes the situation even worse. Completed apartments that failed to sell when they first hit the market are now being heavily discounted. In many cases, older, unsold units are trading thousands of dollars per square metre below what brand new developments would need to charge just to break even. Put simply, an apartment that cost $12,000 to $15,000 per square metre to build and finance might be competing with a finished unit down the street selling closer to $9,000 per square metre. On a typical 2-bedroom apartment, that gap can add up to several $100,000. Faced with that choice, buyers overwhelmingly choose the cheaper option, or they walk away entirely. New projects become financially impossible because no one can justify paying premium prices in an oversupplied market. As you'd expect, developers haven't responded by building more. New apartment completions have dropped sharply. Industry trackers show that fewer than 1,000 apartments were finished in the first half of 2025, putting the city on track for its weakest year of apartment delivery since the global financial crisis. Historically, Melbourne averaged close to double that number each year. This is where the situation turns truly unsettling. Construction has slowed dramatically, yet apartment prices continue to fall. Normally, shrinking supply puts a floor under prices. Here, it hasn't. Across Melbourne, unit values have slipped again over the past year, with larger apartments seeing the steepest declines. This isn't a healthy correction. It's a market that can't find balance. So who's paying the price for this breakdown? The first and most obvious group is recent apartment buyers. People who purchased between 2020 and 2024 are now discovering that time hasn't healed their purchase, it's exposed it. Inner city areas are recording some of the highest loss-making resales in the country. Many owners who held units for several years are selling for tens of thousands of dollars less than they paid. Imagine a young professional in their early 30s who bought a 1-bedroom apartment near the city a few years ago. At the time, interest rates were low, borrowing felt manageable, and buying seemed safer than renting forever. A modest deposit, a fixed loan, and a belief that prices would steadily rise carried them across the line. Fast forward to today, their low fixed rate has expired. Monthly repayments have jumped by well over $1,000. At the same time, comparable apartments in their building are selling below their purchase price. On paper, their loan is now close to, or even higher than, the value of the home itself. Selling would wipe out their deposit once fees are included. Refinancing is difficult. Waiting feels risky. They're financially stuck. The second group under pressure is developers themselves. Construction costs have surged since the pandemic, while sale prices have moved in the opposite direction. Fixed-price contracts signed years ago have turned into loss-making projects. Some builders haven't survived the squeeze. Developers holding unsold apartments aren't just facing lost profit, they're facing ongoing costs. Interest on development loans keeps accruing. Owners' corporation fees, council charges, insurance and maintenance all add up every month an apartment sits empty. When multiplied across thousands of units, the total value tied up in unsold stock runs into the billions. That money can't be reinvested. New projects don't start. Trades lose work. Supply pipelines dry up. The third group affected might surprise you. First home buyers. Apartments were supposed to be the affordable alternative to standalone houses. In theory, falling prices should help them. In practice, they don't. Even with modest price declines, entry-level apartments in inner Melbourne still require large deposits, high incomes, and the ability to absorb ongoing costs like strata fees and rates. Many single buyers simply don't earn enough to qualify, especially once interest rates rise. So they keep renting. But renting is its own crisis. With construction slowing and investors exiting the market, rental supply has tightened. Vacancy rates remain low and rents have surged. For someone earning an average income, rent can swallow well over half of their take-home pay. They can't buy, they can barely afford to rent. And policy responses aimed at boosting ownership do little to help their reality. So how did Melbourne end up here? It wasn't caused by one mistake. It was a chain reaction. First came the building surge. Between 2020 and 2024, approvals and construction raced ahead under the assumption that population growth, overseas demand, and investor appetite would absorb everything. Too much supply hit the market in too few suburbs at the same time. Then construction costs exploded. Materials became more expensive. Labour grew scarce. Delays stacked up. The cost to deliver an apartment rose sharply, but buyers refused to pay more. Developers were squeezed from both sides. Next came the investor retreat. International demand softened. Domestic investors compared yields and began looking elsewhere. When rental returns are eroded by fees, vacancies, and regulation, money flows to markets with better risk-reward ratios. Finally, policy changes altered the incentives entirely. Higher holding costs, stricter rental rules, and rising taxes pushed more investors to exit. Some sold, others chose not to build or buy at all. Rental supply shrank, while unsold apartments piled up. All of this left Melbourne with a paradox. Empty apartments alongside housing stress. Oversupply in one segment, shortages in another, and a market struggling to realign. Recent government measures, including temporary transaction incentives, may increase activity at the margins, but they don't address the core problem. A market built on assumptions that never held, exposed by rising costs and tighter financial conditions. Until supply, pricing, and demand are allowed to properly reset, Melbourne's apartment sector will likely remain stuck in this uncomfortable limbo. For owners, builders, and buyers alike, the consequences of that imbalance are already being felt, quietly but deeply. ChatGPT said, "What makes this situation even more dangerous is how slowly the damage reveals itself. This isn't a dramatic overnight crash with auction clearance rates collapsing in a single weekend. It's a drawn-out erosion. Month after month, values slip a little further, buyers hesitate a little longer, and confidence quietly drains from the system. That kind of decline is harder to spot, but often far more destructive. One of the biggest long-term risks is what happens next if this stalemate continues. With developers unable to clear existing stock and banks becoming more cautious, future apartment supply doesn't just slow, it risks falling off a cliff entirely. Projects that were once penciled in for approval stages are being shelved indefinitely. Land that was acquired for high-density development now sits idle because the numbers no longer stack up. By the time demand eventually returns, the pipeline may be so thin that the market swings violently in the opposite direction. That volatility is what worries many analysts the most. When construction collapses for several years in a row, the housing system doesn't gently rebalance, it lurches. Today's unsold apartments become tomorrow's shortage, particularly as population growth resumes and household formation picks up. The same policymakers who are currently grappling with excess supply could find themselves facing a severe undersupply problem later this decade, one that drives rents and prices sharply higher again. There's also a financial stability angle that rarely enters public discussion. Apartments are often purchased with higher leverage than standalone homes, especially among younger buyers and investors. When values fall below loan balances, mobility disappears. People stop selling. Distressed sales increase only when borrowers are forced out, which adds further downward pressure on prices. Meanwhile, banks grow more conservative, tightening lending standards across the board, even for borrowers with strong finances. Social consequences follow close behind. Owners stuck in negative equity delay life decisions. They postpone having children, moving for work, or upgrading homes. Renters facing high weekly costs feel permanently locked out of ownership, fueling frustration and disengagement. Construction workers face unstable employment as projects dry up. The effects ripple far beyond the apartment towers themselves. What's striking is how disconnected official narratives often are from these lived realities. Incentives aimed at stimulating transactions assume there's plenty of willing demand just waiting for a nudge. In truth, many buyers aren't hesitating because of stamp duty or minor cost barriers. They're hesitating because they don't trust the market. They've watched prices fall while interest rates rise. They've seen friends lose deposits. Confidence, once broken, is incredibly difficult to restore. The deeper issue is misalignment. Apartments were delivered in massive volumes, but not always suited to how people actually want to live. Many units were designed for investors first, residents second. Small floor plans, high strata costs, limited owner-occupier appeal. All of these features limit demand, even when prices fall. Discounting can move stock, but it can't fix fundamental desirability. Until that imbalance is addressed, between cost, quality, and genuine demand, Melbourne's apartment market will remain under pressure. The empty apartments are not just statistics, they're signals. Signals that the old assumptions no longer hold, that policy shortcuts can't override market fundamentals, and that ignoring the underlying problems now may simply defer a much harsher reckoning later. What looks like a quiet oversupply problem today has the potential to reshape the city's housing landscape for years to come. The only certainty is that pretending it isn't happening will not make it go away.